partner, being one of the first funds to launch. That's going to cover this portion of the United States, the Southwest, and then more importantly, being one of the first funds to launch in New Mexico. Deborah has a wealth of knowledge, whether it's working with large institutions out of New York or coming back home to where she is from, a native New Mexican, and spending time with the foundations, spending time with small businesses and her partners with InvestUS to help get capital out off the sidewalks and actually into the community that it needs to go to. So with that, I'm proud to introduce Deborah Burns.
It's great to be here. I am so appreciative to Alicia and NMEDD for sponsoring this forum. And I have to say, I first found out about this whole thing in March of 2018 when Juan Torres texted me while I was in Beijing saying, Deborah, you gotta check out this opportunity zone legislation stuff. And from there, I got to see the state really do their best in a very short time frame to collect nominations for zones that qualified as low-income census tracts, but were ripe for development, which is key, right? Because we're competing with all the rest. There's the controller. And then they just continued. Susie Russell was the first of the regional reps to, like Ryan said, put us on the road. I think we were like in 6 cities and 2 trips, and it's just continued from then. And I can't tell you enough how important it is, and I'll get into it further, these community meetings to educate the players. So there's 8,700 opportunity zones. 1,800 of them are in the 70 fastest growing counties. Think major cities where all the capital goes anyway. And 5,400 of them are not in those major cities. And New Mexico has 63. We actually have some pretty impressive zones for development, but if you were wondering what we were up against, I want to give you, if you don't have a suitable sort of sense of urgency about this, I'm going to give you some statistics. One about the national urgency around this program, and then the state needs around this program. To just start, before I go into promoting. We like to kick ourselves a lot in New Mexico for everything we do wrong. But the truth is, nationally, in the last decade, the poorest half of the US population has lost more than 50% of their wealth. So we're not alone. We're in that group, but we're not alone. There are states all over the country that have this same problem. And people like Bill Gates and Warren Buffett have gone on record as saying they're alarmed by this and they think they should raise taxes on themselves. I think that's great. But the reality is, I have no confidence that money ever finds its way back to places like New Mexico, even if they did. So what that means, and then how many of you have heard of Ray Dalio? I'm just curious. Okay, so Ray Dalio is the Warren Buffett of professional money managers. He grew up in the middle class family, is worth $18 billion. He started a hedge fund that's the largest hedge fund in the country with $160 billion and deemed to be the most successful. He was on the July 28th 60 Minutes saying the #1 threat to the United States, ahead of cyber attacks, terrorism, nuclear war, pandemics, is this growing inequality in wealth in the United States, the haves versus the have-nots. I recommend you go online and Google that 60-minute story. He's the guy your pension manager, your investment managers all listen to. And he says, this is serious. And he thinks there's a 2/3 chance this leads to conflict. And 1/3 chance we figure it out together. In addition, and this is a little old and I apologize, I didn't have time to update it, No offense to the bankers in the room, but I'm a financial analyst, and you can't grow an economy without all kinds of capital. And from the time of the financial crisis, for 8 years after that, the average amount of bank lending in this state declined on average 5% a year. At the same time, some economies known for being equally sort of not so great, Hawaii and Mississippi. Hawaii's bank lending grew 17.1% a year, and Mississippi's grew 8.5% a year. So while we lost 40% of our lending capacity over that period, they grew 80 and 70%. You can't grow an economy without sufficient access to capital. And to Terry's point, if I don't get a chance to come back to it, there are lots of non-bank lenders in addition to banks interested in lending in zones. So a lot of attention is being given. I get called regularly by these people asking if I have, and they're willing to do construction and loan debt. It's usually more expensive than bank debt, but they're eager to lend into zones. And so we wonder why our economy, which is that orange, really bad looking line. I mean, this is as of 2015, so it's come back a little with the oil and gas boom. But, you know, sequestration and oil and gas declines, the bank lending has only exacerbated it. And so, on top of that, think about this. Every dollar that every person in this room and in the state puts into 401k, an investment portfolio, if you have a pension plan, is managed by somebody out of this state and largely goes to public companies and publicly traded securities, with none of it, almost none of it, coming back to the state. So think about that for a minute. And I've had some really good conversations with pension managers and asset managers who manage, Susan O in Pennsylvania manages $20 billion of the teachers' retirement program in Pennsylvania. And we're having some really good conversations because I said, you're systematically impoverishing your state, all your teachers in your rural communities. And so is every other big asset manager, because they set their investment criteria at minimums that preclude investment in places like New Mexico. A lot of these financial managers and wealth managers, their minimum fund size is $500 million to $1 billion, and their minimum equity deal size is 30 to 50 million. You might occasionally maybe get one of those deals in Albuquerque, but you know, we're not alone. Most of the country is in this same problem. All our money is going to fund economic development in the 70 fastest growing counties, and we wonder why they're growing, right? So we've got some real big headwinds nationally. And don't get me wrong, look, every person's financial situation, portfolio should have a lot of publicly traded and liquid securities, and I'm not dinging any of those firms here in the community. I'm just describing the capital barriers to getting money into the lower half of the US population, which includes New Mexico. Understood? So what do we need to do? And I don't know why my slides are all screwed up, but we have to, if we're going to survive, we have got to encourage private capital investment in our state. We don't have good conduits for that right now. These opportunity funds can be one conduit. There should be private equity funds like there are everywhere else in the country that fund growth companies, that fund mezzanine debt, that fund all kinds of investments, because apart from the publicly traded securities, most wealth managers have private portfolios apart from publicly traded stocks and bonds, and they're all investing in very large deals. So Let me just talk a minute about why this program is so powerful for enticing investors that wouldn't otherwise invest in our state, or maybe live here and have always sent their money out of state to invest here. If nobody's actually described these tax incentives in detail yet, there are 3 benefits to a US taxpayer of taking advantage of this legislation. If you're a US corporation or individual that pays capital gains tax, so not pension funds, and you take a capital gain on anything, sale of a business, sale of a piece of art, real estate, sale of a stock in your portfolio, you can defer the capital gains tax on that gain till 2026 as the realization date, so really you pay April 2027. If you take just the gain from that sale and put it in a qualified opportunity fund within 180 days. That means the rest of the proceeds you can do with whatever you want. From a 1031 exchange comparison, you know, 1031 you have to roll everything over. In this program, you only have to roll over the gain into a fund within 180 days. If you do it this year, come 2027 when you pay the tax, you'll only pay 85% of the tax. Next year, you'll still get a benefit, but you'll pay 90% of the tax. And in a couple of years, you'll just pay 100% of the tax. But you get to defer it and use that money to invest and accrue value between now and 2027. But the lion's share of the benefits comes from the third incentive, which is once you put the money in the fund, if you leave it there for 10 years, the value that builds up in the fund at exit, which would be deemed to be a capital gain, is totally excluded from capital gains tax. And so anybody that manages money, this is real money. Someone once told me wealthy people don't get rich by making money, they get rich by minimizing their taxes. So family offices, wealth managers that have taxable accounts, this is real money. And even though it's illiquid and you have to make a 10-year commitment, if you're building wealth as part of your portfolio, this is why people are pretty excited about this if you're an investor. So let me just also go through this because I don't think we really did this earlier today. The legislation requires these 3 pieces. You can't just be an investor with a capital gain and invest directly in a business or project in your opportunity zone. The legislation requires you put your money into a qualified opportunity fund within 180 days, and then that fund has to deploy at least 90% of that money into qualified opportunity zone property, and that's a defined term. That doesn't mean real estate. That could be stock, partnership interests, or tangible assets, but they have to meet the rules for being a qualified opportunity zone property. And those rules were partially released on October 19th in guidance from the IRS. Another round came April 17th that defined more about the business aspect of it. And the money at the fund level can be redeployed. So the investor has to keep the money in the fund for 10 years to get the exclusion, right? But the fund manager, within the guidance and the rules, can actually invest in QOZPs and exit and redeploy, and exit and redeploy over those 10 years. And that was in the April 17th guidance. So I just want to get these terms down. The QOF is the fund, the intermediary special investment vehicle, and the QOZPs are the businesses or projects that meet the criteria to get the tax incentives. And they're complicated mainly because the IRS doesn't want to give people a free tax break. They want them to really generate economic activity and jobs in these zones. But they want it to be flexible and scalable. So the body of rules coming out is helpful for helping people navigate and actually use the program, but it gets a little involved. So I just want to make sure everybody understands why this is so powerful. And again, my slides are screwed up, but If you want to promote this legislation, you really have 4 target audiences, okay? As Terry and Matt and Rich mentioned in really good detail, thanks Rich for that great example. Because I've been in some of his meetings and there's like 40 or 50 people in that room every time. You have to have these community meetings where your businesses locally know about this. There are business owners every day facing expansion or growth decisions where they're like, I don't know if I make this investment, it's kind of risky, is there a return? But if they knew about this, where they could get some help, or they could actually invest their own capital gains, they might make that growth or expansion decision. Nationally, you should expect, I've already heard of this happening and we've already been approached regularly, there are businesses looking to expand across the country in opportunity zones. So you need to identify what businesses you need to attract and make it really clear on your website what you're looking for. Because there are companies out there looking to expand. Developers, obviously real estate. Fund managers, and I'm going to go into these in detail, and investors. So on the business side, you have the benefit of the entire federal government's agencies, the state incentive organizations, the local incentives, the foundations, the nonprofits, all eager to help expand businesses in zones. Even if you don't have any capital gains, if you don't take advantage of this to expand your business, you're missing a huge opportunity. In addition, Terry is a huge resource. I'm glad he keeps track of all those programs and incentives and agencies and what they're doing. I'm often sort of ask people who want to do something with their business, what are you going to do, what programs are you going to take advantage of to attract investment to your project or business? Because there's a ton out there. And you're competing with investment dollars from all across the country. Some of the cities that have done a great job of having these meetings in addition to Santa Fe, Portales, Silver City, and Roswell, where they put together diverse groups as early as last August. I routinely get calls from companies looking to relocate to New Mexico or asking me about places they can relocate to. If I don't know that you have an industrial park that you're ready for some manufacturing, I can't possibly steer them your way. Developers, we got some great resources on our table, and Calvin Davis from Galtmore is back there. There's a community, Silver City spent 7 years applying for HUD and Colonias money to build infrastructure for very much needed housing. And I was with Priscilla Lucero going back to the airport after Mark Lautman and I were down there doing one of these community meetings. And she mentioned this, and I said, well, what are you missing? And she said, I need a developer. Well, the developer would love to go into a place where they've already done all the groundwork and done all the infrastructure and been at it for 7 years, because that demonstrates the community's committed. They've taken a lot of the time and energy and effort. I mean, Calvin will tell you, down in Silver City, it saved them like 100 steps as a developer. So taking a long-range view to what Terry was talking about, to take advantage of these programs and start getting the infrastructure and getting the permitting and entitlements done is really terrific. The other thing is Santa Fe did a great job of streamlining their Midtown corridor permitting and entitlement process. So did Albuquerque with their IDO. And so there's lots of communities around the state that are taking steps to be a developer-friendly community, where you actually have factual statements to share with would-be developers on why they should come to your community, right? California developers, when we go to these opportunity zone events in California, they're getting priced out of their market. The cost of land, taxes, construction costs. People who build senior living or affordable living or other types of real estate are looking for where they're going to move because they can't build in California anymore. So your community could attract them. Investors. Whether it's Milken Institute or EIG or Novogradac or anyone else, Rockefeller, Kresge, all of them, they will tell you the best way to attract investment to your community is your high net worth individuals and companies that are right there in your community. So another reason for the community meetings, as Rich pointed out, is you have pockets of wealth, even if they're not billionaires, who know your community better than anyone and who know the need, know the operator, know the developer, etc. Those are the people that are the low-hanging fruit. And they don't even know about this tax incentive. Most of them, I'm the first person that tells them about it if I talk to them. So starting to have these meetings, starting to get CPAs and accountants, tax attorneys, professionals, financial advisors in your community up to speed on this program is the best way to bring the people with gains in your community into investing in the future of your community. And a lot of them, they would love to do it, they just haven't found a prudent way to make it make sense. So now the really fun part, the fund managers. Ryan kind of alluded, I'm a native of New Mexico. I grew up here in Albuquerque, and my first career was 17 years in New York as a private placement institutional investment officer for a large insurance company and then the world's largest private pension fund. And so I did private placement investing for a living for 17 years in New York. So I first and foremost think like a fund manager, because I was one. And the good news is there's 212 opportunity funds listed on some of the registries that are offering investments of $57 billion. You heard earlier today there's potentially $6 trillion of capital gains that could be incented to be invested in this. So on the surface it looks really, really exciting, but if you dig a little deeper, what you find is that just like the way all capital moves in the United States, most of those funds are real estate funds focused on major markets. Very few of them are looking at businesses, and if they are, they're often just targeted industry segments. So far, the industry, the investing fund world, is doing what all investment funds have done, and not really focusing on the lower 50% of the US population in the non-major market segment. That said, when I first formed this InvestUS Opportunity Fund, I went at it first as a private placement investor, and I looked at the legislation and I said, okay, if I was sitting in New York and I was trying to craft an investment strategy to get the best returns for investors over a 10-year period, what would I do? And private placement officers love market inefficiency. They love obscure, they love misunderstood, complex, out of favor. New Mexico's like a dream sequence, right? and they love it because if they find a good deal, there's no competition, and they get paid really, really well. So my case for the InvestUS Opportunity Fund doing $100 million diversified portfolio of opportunity zone businesses and projects in smaller cities and communities just happens to fit the needs of New Mexico, but actually I think, I'm probably a year to year and a half ahead of the market on this investment strategy. But I think it's, in the long run, going to yield the best returns for investors. And that's the case that I take to these people. Because the incentives are not really getting investors to cut their expectations on their pre-tax returns. What it's doing is it's perhaps hopefully, with any kind of luck, going to give them the sense that they could step out and invest in some things they've never invested in before, with the sense that, okay, so maybe this should make a 12% or 14% IRR, but if I'm wrong, as long as it earns some sort of gain, the tax incentive will make up the difference. So it's really, from an investor perspective, from a fund manager perspective, you can't cut the returns to investors on a pre-tax basis based on these incentives. It really is just an incentive to get them to come and do things they haven't done before. And if you want to talk to me more about that, I'm happy to explain. One of the things about funds is they are securities offerings, so they have to be compliant with securities laws. And you should be very careful about managing a fund with other people's money if you don't have the credentials and track record to do so, because you're setting yourself up for potential liability if whatever happens that doesn't go the way it's supposed to goes sideways. So the one thing I will say about fund managers, and I'm going to get into it, is you basically have 1 to 2 minutes to say something to them that's accurate and factual, that's so compelling they want to listen to you any longer. And you've probably seen it with the VC guys. You basically have 3 slides to convince them that they want to hear anything more. Well, the same is true for fund managers, investors, and those types of people. So if you don't listen to anything else I say, and you want to take away something of value from this presentation, I think the thing that we do really poorly is communicate at a level that it will bring capital and development and businesses to our communities. We don't distill who we are and what we have to offer into 1 to 2 sentences on each of these topics. You should be able to say a compelling and clear statement with facts, like data, like numbers, about each of these items. 1 to 2 sentences. If you can't do that, you're not ready to talk to a fund manager or an investor. Does that make sense? And I'm a friendly audience, but the people who want to come in and spend 2 hours of my time without telling me why they have something that's worth me taking 2 hours of my time is unrealistic. Even if I give you the 2 hours, nobody else will. So you've got to be able to answer and speak to this very succinctly, and you should probably have talking points that you've written down that when they call you at the worst possible time. There are people cold calling communities. They're calling communities up and they're saying, I hear you have an ozone, tell me about it, you know? So you want to pull out your piece of paper and you say, let me tell you about our opportunity zone. And you will get those opportunities. You won't get a call from investors. You'll get a call from businesses and developers. Okay? So if you don't do anything else, do this. 1 to 2 sentences on each of these, and 1 to 2 sentences on any of the likely follow-up questions, so that you can speak to this succinctly. So it's really hard to do that if you don't have a plan for your community. And again, I apologize. This looked beautiful on my computer yesterday. If you don't have an economic plan for your opportunity zone or your community, it's going to be really hard to get any traction. I'm using Darren's over there. It's easy to feature Winrock in my offering materials because, one, it's a proven, reputable developer who has a track record. This left photo is the 2B schematic for the redevelopment of the Montgomery Wards building, which if you go to the IMAX theater like I do with my 16-year-old husband all the time, doesn't look anything like this right now, but will, and it'll be beautiful. But it's not just that. It's the right This is the rest of Winrock that's going to be built out over the next 5 to 10 years. Sure, the long-term lease they have for the Montgomery Ward's building makes all the sense in the world from an investor perspective, but I'm looking for a gain. So what builds value in that building? All of this, right? So that when I exit, the exit value on that property is far beyond just the lease payments of the tenants that they've signed to go in there. It's really that this is going to be like the hottest place to be. You know, sorry developers, you probably have something to compete with this, but this is easy to sell nationwide because all across the country regional malls are being converted to live, work, play communities, and this looks really nice. They've spent a lot of time and energy to attract investors. So you have to think your business and project, people are not going to invest in it alone. It has to be part of a community, an opportunity zone development plan, something that's going to build value over time besides just that project that will be successful the day it opens. Does that make sense? So I listen to people all day long. Unfortunately, too high a percentage of them, I think this is what they look like. You know, they like call me up and say, so we got this zone. And don't get me wrong, I'm all about educating and helping people plan. But when you talk to an investor or a fund manager, and I am a fund manager, and you can practice on me and I'll give you some feedback. You cannot talk to them. I listen to every word a person says. And I am calibrating that person by everything that comes out of their mouth. And every fund manager does. So you want to have a really clear, compelling message, or don't pick up the phone. You're only going to do yourself and your community a disservice. If you need help on developing your message, I'll help you. But you've really got to dig into this and have your talking points if you want to attract capital, which is the hardest part, right? So to end on a positive note, this is a map of migrations that came from an article written by Glenn Kelman, who's the CEO of Redfin. And the whole gist of the article is the past is not our future. Things are changing. Technology's changing. People are becoming more mobile. Data is readily available. This is just a map of major migrations tracked on Redfin. The red is the origination point. The blue is the destination point. And this is just for 2018. And the gist of his article is, there was a time when, I'm getting to my notes, sorry. Cities like Detroit, Pittsburgh, Pennsylvania, Philadelphia, Baltimore, Providence, and Milwaukee were left for dead. But when demand returned to a country that was no longer investing in housing, these were the cities with the housing reserves to take people in. The folks who couldn't no longer afford San Francisco, New York, Washington, Seattle, and Chicago moved in a trickle at first and then in great waves. This has turned out to be a fundamental narrative of the 20th century, American migration. And basically, migration patterns now shift from city to city in search of affordability, driving up prices in Seattle before moving to Denver, then to Portland, then to Nashville, then to Salt Lake, with longtime residents starting to leave a city even while the number of people are still coming in. This cycle will continue for years to come, straining the social fabric of one city after another, but bringing prosperity to America's once forgotten places. I was speaking to a data guru who I think has a lot of credibility. He said, Austin has peaked, okay? So a lot of these markets are peaking, have peaked, are starting to leave. People are leaving now. I think New Mexico can attract a lot of these people. Some will want to go to Santa Fe, some will want to go to Albuquerque, some will want to go to Cruces, some will want to go to Silver City or Clovis or Portales or Farmington. They'll all have their own reasons for going where they go. But where's Julia Brown? Where's Julia? So Julia relocated here from San Francisco. But first she did an exhaustive research of 10 cities, 7 in the US, 3 outside the US, and she landed in Las Cruces. People are going to search for the place they want to be on the internet. And so what NMEDD has done for the state, what Rich Brown and other cities are doing for their city is critical if you want to attract these people. So I hope I haven't gotten too preachy. I'm really passionate about this. You know, I love this place. In 17 years, I did deals in 45 states, traveled to 20 countries, did deals in 10 of them, and I'm here. And I'm a structured finance Wall Street person in Albuquerque. What the heck am I doing? But I actually had an experience where I had the opportunity to do something new and innovative in a very mature industry. And by meeting a need of some high net worth individuals. And it became the Thornburg mortgage story. We went from 0 mortgage originated to $11 billion a year in 7 years, and we had the lowest default and delinquency rates in the country. And we did it in Santa Fe with 200 people. So I think we have so much potential, and I know we tend to focus on all our problems and all our issues. Travel in China for a while. I mean, there is a place that has serious problems, and I actually wonder if they're on the brink of being the Soviet Union of the 80s. I actually think these things going on in Hong Kong and elsewhere in the country could be the decline. So don't believe everything you hear about China being the next world power. I think you shouldn't believe everything you've heard or hear about New Mexico. I think we have tremendous opportunities here and tremendous investment opportunities. And I'm just really glad to be here. I think this is really exciting. I'm going to the White House later this month as a capital markets expert to talk about all the capital barriers to getting money into smaller cities and communities. Actually, not later this month, in September. Because I think our fund is a solution for the Ray Dalio issue. And I think they're having me come because I think the administration, the congressional leaders, all the departments and agencies recognize that all the money is flowing to major cities, and this program's not going to survive if that continues. Senator Tim Scott, who was one of the biggest proponents of it, has already said he's going to kill it if it doesn't flow to places like us. So I hope that you feel this sense of urgency, this sense of desire to talk to high net worth individuals in your community, businesses, developers, and really start making this happen. And I really would like to open it up for Q&A. Yes, Steve.
Thank you, Deborah. I appreciate your presentation. Just a quick question as we're looking at, you talked about the state of affairs in New Mexico, talked about, what we want to do to push ourselves forward and capitalize on the opportunity zones. I have kind of a two-part question, but in our conversations, how sophisticated does an investor have to be for us to have a good conversation with him? And how small is too small when you're talking to a business?
Okay, take the first question first. How sophisticated does the investor have to be? That's a good question. All my investors to date are from Oklahoma, New Jersey, and Texas. And there's this long string of investors from New Mexico sitting on the fence. So the knee-jerk reaction for most investors is, oh, if I'm making a real estate deal, I'm going to a major market. That's where all the growth is. And you wouldn't be totally wrong, but from a private placement perspective, I sit there and I go, well, wait a minute. There's 1,800 zones. Everybody's looking at those 1,800 zones. They're crowded, they're competitive, and they're efficient. Why would I want to compete in those markets? Why would I want to compete for a luxury high-rise a stone's throw away from the Staples Center if I'm an investment officer? They're going to drive the yields down. So I think from an investor perspective, you either have to be a believer that there's some great investment opportunities right here at home, or you have to be sophisticated enough to understand efficient markets versus inefficient markets, and that the overlooked markets often have some of the best returning opportunities. So does that answer your first question? Now there are investors who just want to change their community, and there's 10 families that have grouped together in one community, and they didn't even wait to figure out the capital gain thing. They just started putting money into a project. I was like, go for it, you know, if you don't want to do that. So I think there are some people who are, you know, the high net worth individuals really don't have good conduits of investing here. There aren't private equity funds that are reputable, that have a track record for them to invest in our home state. And we've got to change that, right? So what was the second question again?
Well, with small businesses, you're talking to small or businesses that are curious about opportunity zones or that we think might be good for opportunity zones. At what point is the cutoff?
Yeah, there isn't a cutoff. So there's different ways to do it depending how big you are. If you're just a business that can structure a QOZP and put your own capital gains in it, you really have no liability other than making sure you get it right with a tax advisor. You can form your own qualified opportunity fund, and you can put that money into your own business. And again, you need a tax advisor to do this right, so you get the tax incentives. And it could be as big or as small as you want. You have to comply with the rules. There's some administrative and compliance expense, but you can do that. And a small group of people can get together, and if you trust them so that they're not going to sue you if it doesn't turn out, you don't need to do a PPM or any of that. You can do the way you do any real estate deal or any business investment. I think where you start getting, where size matters is when you're taking in other people's money. You really should have a private placement investment memorandum. You really should have a fund administrator and fund manager who are really fiduciaries for the investors. And you can do it pretty cost effectively. We went ahead and we've been helping some businesses who had their business that was in a zone and had their pool of investors. And we're helping a group of them form their QOZP, and then for a certain number of them, we formed a fund for them. And we're kind of a passive fund manager, because these businesses might exit in 5 years, have an exit, and those people in that business don't want to be responsible for those investors staying invested for the other 5. So we become an active fund manager for the remaining 5, and we've tried to do it as cost effectively as possible just to get the program working. So I don't think there's really a size. There's just a matter of when you start managing other people's money and you have to create a fund, there's, I would say, 5 to 10 million is probably where you're not going to just get killed by administrative and legal costs. But we did one for as little as 3 million. Does that answer your question? Okay. Hey, Ryan.
There was a question earlier from a gentleman about, I believe part of his county being split, part of it is in an opportunity zone, the other part isn't, and maybe his operating business isn't in that opportunity zone, which may be the case for others. There are rules and regulations that kind of define it, the 50% rule, but it's very technical.
Yes.
Can you say, it's easy for the state to say, hey, here's what you should do, but maybe it comes better from
So let me just say, I'm not an accountant, I'm not a tax attorney, and I'm not a CPA, but that's all I talk to. So I know a fair amount. So this legislation was designed for startup businesses, for business expansion, whether the business is in the zone or the business is out of the zone, wants to do a significant expansion into a zone. So there are scenarios under which you could do all of that. It's also for developing something from scratch or redeveloping a building, whether it's been empty or occupied for the last 5 years. And there's all these rules around each and every one. So the idea was to make it as flexible and scalable and as applicable to businesses as possible. I will just say one thing. If you're a startup company, it is possible to make this work. My fund, because I have enough of an uphill battle, I'm not doing pre-revenue startups, but I've already had conversations with people like Bill Bice and Wayne Savage from Arrowhead and other people. There are people in the country that are doing that, and I know the one tax guy who's been working on nothing but startups for a year and a quarter from Node Radek. So I probably will not be able to do it in my fund. However, some of the deals I'm helping fund are startups that already had a pool of investors, that had capital gains, and realized, oh, if I can live within these rules, it just helps me complete my capital raise. So I just want to get that out there because there is a way to do it. My fund is not it. Questions?
I have one more question.
Sure.
Please.
Oh, and there's one over there.
My question is, it's more of a statement and then kind of a homage to the funds that we have here. Is at a conference there was a large investment banking institute that was putting on a rural discussion on how to invest in rural communities. And so New Mexico, Montana, Nebraska, and Oklahoma were present, and they showed us information about the rural investment into Austin, Texas, and into San Antonio. So are you able to elaborate a little more on the difference between your local fund that are started by New Mexicans versus these out-of-state funds? And if and I shouldn't say out-of-state funds, these larger funds, and then kind of the difference in return on investment that they may be looking for.
Okay, so the question was, if I could distill it down, there are funds out there, or investment bankers saying they will invest in smaller cities and communities, and how to do it, and featuring places like Austin and San Antonio, which, I don't know about you, but to me, that's not real. And what are the types of returns they're offering versus the types of returns here? So I spent a lot of time talking with a lot of people in this space, trying to figure out who, if anywhere. I think it would be great if a bunch of funds came here and wanted to invest in rural communities. I'd love to see it, okay? The truth is that I know of two funds that are really trying to do rural. One of them is out of Salt Lake and is offering two $30 million equity deals. So to me, that's not really New Mexico, small communities. The other one is a rural Colorado, and they're heavily funded, but they're just doing Colorado. In terms of returns, anybody in this room can go online and start looking at Virtual Partners out of Phoenix and some other folks. They're offering some returns between, in terms of the IRRs on the projects, 16 to 18 to 19%. After the returns, you pay the fund manager and the fees. I think they end up getting 12 to 14% at most in the major cities, and I think a lot of them will get more to 10 to 12 in Los Angeles or someplace like that. Initially, I think over time, it's going to be really hard to maintain those types of yields. I welcome anybody who wants to challenge me on that. What I go by is the longtime developers in the tertiary and smaller communities, of which we have some, and they basically say, Deb, I can get 4 to 6% higher return on my projects in New Mexico than I could get in San Diego or LA or wherever, and so that's why I'm here. So, does that answer your question?
It does make
Yes. Go ahead. Okay, so the question is, can Opportunity Zone legislation be an attraction for foreign investors, foreign investment? It can, in the sense that, one, if they have US capital gains, they can be treated just like every other investor who wants to defer, reduce, and exclude capital gains from their taxes in the US. I think what's going to be interesting about this, and I think Julia Brown brought it up last night at dinner, back in the 80s, none of the banks were investing in small communities and underserved communities, and they came out with the CRA loans. And Bank of America said, wow, these are really good loans. And I think what this Opportunity Zone legislation has the opportunity to do is bring a whole new class of investor that has kind of ignored places like New Mexico in here for the Opportunity Zone investment. And then as they see what's going on and what the opportunities are, they stay and start investing non-capital gains as well. Does that answer your question? I'm sorry, sir. I'm a little, okay.
You're going to have 180 days to invest in the fund. How many days does that fund then have to actually invest in the fund?
Okay, so the question is, if the investor has 180 days to invest in the fund, how long does the fund have to get 90% invested? It's a really good question. So, and just on the 180 days, if you have a K1 from a partnership, your realization date is deemed to be the end of your calendar year or your taxable year. So for all the people who took a gain in 2018 in a partnership, their designation date was 12/31, and just before June 28th, which was 100 days after that, they all tried to get invested. So the K1s, you get a little leniency. Okay, so the fund has to be 90% invested in QOZPs, and they're measured twice a year. But there's some flexibility in the ramp-up period. So basically, they need to be 90% invested in, preferably a little more than that, just in case something happens unforeseen, they won't violate the test. If they go below 90% investment in QOZPs every 6 months, there's financial penalties that are pretty stiff, but you can get back into compliance during that period without blowing the tax, status of the fund. Does that answer your question?
Yes, so it's twice a year. Is there a set date every year, or is it?
I knew you were going to ask me this question. So after your initial period, it's every 6 months on 31st of December and the June 30th. Your first period can actually be a little longer, and I'm not going to try to articulate it. But call me and I have an email with all of this sitting in my inbox. I just can't pull it up right this minute. So,
Thank you.
yep. Questions? So, as I mentioned, while I'd love to talk with all of you and have a really great conversation, I don't think it's realistic. But there are sign-up sheets in the back for different types of things we talked about that you might want to talk more about. And Calvin Davis from Geltmore is back there with some really great sheets he put together in terms of, from a developer's perspective, what should a community do to streamline and get development and investment in their community. It's a really great resource. It's like step by step. I have to kind of be careful because if I'm an investor, I can't tell you how to put together your deal. So I try to, if you come to me with questions and I can't answer it, I'll try to feed you to various resources that InvestUS has or is related to, and try to help you make progress. So that's it. Thank you.